Mohamed, dare I say, is this becoming a consensus view to go long core government bonds to add to duration?
It is, and it's striking because look at the levels. So even though I'm still very worried about European growth, and our rate here has been a function of what's happening in Europe, I just look at the levels and I find it very, very hard to say with conviction that it makes sense to go out the curve at these levels. So, I don't have a strong view one way or the other. I think if you're going to take fixed income exposure, take it in the front end. But I can understand why people would buy even at these low levels of yield.
Well, Mohamed, you say take it at the front end, but increasingly what I've heard over the last couple of weeks is add to duration. The Federal Reserve is out the game. There's an asymmetric risk here. The risk is that yields can go a lot more lower than they can higher. What do you say back to that? Just how vulnerable the market is as it adds a little bit more duration over the last couple of weeks?
I say first be careful of being technically crowded. And I would say look at the levels. Just look at the levels. We tend to always think of deltas rather than absolute levels. That tends to happen in particular in high yield or emerging markets when people are just looking for a pickup in spread regardless of what the overall level is in terms of protecting you against defaults. So I just say look at the level. Look, I understand the argument, Jonathan. I wouldn't be doing it here. I really wouldn't be doing it here. But I understand those who are tempted to do it.
Do you think we're underestimating, perhaps underpricing the inflationary risk here, Mohamed?
Maybe a little, but just look at the levels. I mean, just look where we are around the world. It's a level issue rather than a delta issue.
You've made that point, and I think it's an important one because it's hard to reconcile what has happened with risk assets through 2019 so far. Take credit, take equity, and compare it to the resilience, in fact, the performance as well, in core government bonds. Is that a little bit of tension that needs to resolve itself?
Yeah, although, Jonathan, that has to do with the Fed. Okay, when the Fed goes and says two things that the markets were dying to hear. One is patience on rates, and two is we're going to be flexible on balance sheet reduction. A, it's a green light for risk assets. B, it's a green light for owning duration. So I can understand why historical correlations break down when the big driver is such a dramatic change in Fed signals.
Last week, it seemed to go beyond that for a moment, though, Mohamed, when the Federal Reserve not one just backed away, but also the European Commission came out with those growth forecasts. It was stunning to me that this market hadn't priced down European growth enough, that they needed the European Commission to tell us that growth was going to be even worse this year. Why did we need that as some kind of surprise?
Because the US has captured all the attention and Europe has flown under the radar screen. You've heard me say this over and over again, whether it's in the central bank space, the Fed versus the ECB, or whether it's in the economic space, the US has dominated the headlines. So the ECB has flown under the radar screen, even though its policy challenge is much more complicated than the Fed, even though it is going to change presidents this year. And similarly, the European economy has flown under the radar screen for markets, even though growth is slowing in all of the major economies.
So, Mohamed, the sense I get from you is that you're slightly more concerned about Europe than perhaps China. Would that be correct?
Yeah, I wouldn't say slightly. I'm a lot more concerned about Europe. I keep on taking the analogy of a sports team. Would you bet on a team where your major players are all having issues and they're not playing anywhere near their potential, and there is no teamwork in terms of the overall team? You wouldn't. And that's what we're seeing in Europe because of the politics. This is not an economic issue. This is a political issue.
So let's talk about what this means for US markets, because that will be a perspective that a lot of people will want us to explore. From the US perspective, there is a belief that because of the fiscal stimulus, we are somewhat insulated. Because of the structural issues, the dependence, less dependent on international trade, the United States is also insulated. What's the channel from a severe slowdown in Europe or a policy mistake to the United States, to the rest of the world?
So, there's two channels. One is simply that external growth is less buoyant and that we have issues not only in our direct trade, but in our third country trade. But as you point out, we are a relatively closed economy. And the second issue is that this causes a market dislocation that transmits back to the US. That's why you hear me say, while our growth momentum is strong in the US, it's a good idea to add petrol, to add gas to the growth car, and that's why an infrastructure program would come in. We have gas in the car, so we can overcome the headwinds from a European slowdown, but it's not a bad idea to top it up with more pro-growth policies, particularly on infrastructure.
To be clear here, Mohamed, do you think the US needs even more stimulus?
It's not stimulus. I think the US needs more structural pro-growth policies that crowd in the private sector and that enhance productivity growth.
So as we sit here and we talk about this really bad situation in Europe, I think what's been remarkable for many people, Mohamed, over the last couple of weeks, the last couple of months, is this massive demand for debt on the periphery. I can't reconcile those two things. If global markets are very concerned about the continent, the policy response to the slowdown, why is there this massive demand, this insatiable demand for European peripheral debt so far through 2019?
And you're right, you saw it with the Italy issue recently. Simple. Take the interest rates on bonds all the way down to 14 basis points, and people would stretch for yield even more in Europe. So when a peripheral comes along, they will stretch for yield, and they'll hope that you'll have a repeat of the past game, which is that if problems occur, the ECB will step in.
So, Mohamed, how would you manage your European exposure right now, fixed income specifically? What would you do?
I would go up in quality in fixed income. I think that is the key issue. Take advantage of this window to go up in quality, because I think that's going to be a very important trade.
Well, what does that actually mean, Mohamed? Because for many people, that just means buy bonds, and they've seen a massive move over the last month or so. What does it ultimately mean?
No, I think it's reduced peripheral exposure. Look at your corporate holdings, both in high yield and in investment grade. Go up in quality there, that sort of thing. So it's across the board in fixed income, and not just in government bonds.